Um, okay, would you mind that we record this?
Oh, no problem.
Okay, thank you. Let me just carry on talk about the IR Society. So ISES refers to the International Society for Energy Transition Studies. It is a worldwide non-profit professional organizations. It's currently based in Australia. So we have now 40 plus nations and hundreds of members across the world. And the aim for these societies is because we realize the importance of energy transition across the world and its implications to the worldwide economics. So, and also there are many issues that deserves attention from the academic society and also collaboration with the policymakers and practitioners. And that's a few years ago, Xunpeng and a few other peoples together, we think that we need a proper organization to deal with relevant issues. So in June 2020, we had the first meeting to set up this organization. And the aim of the organization is to facilitate equitable and inclusive transition of energy and relevant sectors towards a sustainable low carbon future. And some of our objectives and missions is really trying to contribute to the debate on energy transition with a balanced consideration of both fossil fuel sectors and alternatives and many other energy transition issues. So I think there's a lot more to do, but because of the pandemics, some of the actions we have to move it online and they slow down us a little bit, but the progress are quite impressive according to the last 2 years data we had. So this V-Dialogue series is we trying to bring scholars, the leading scholars across the world, and trying to connect the academic research to practitioners and policymakers and trying to spread this our ideas about what's going on there. And also we want to provide information to people who are interested in energy transition or the things around the world, what's happening in the energy market, like oil market recently. So, it's really a great pleasure. We have Professor Lutz Kilian to be the first speaker of our V-Dialogue series. And so I think most of our audience here, I think is familiar with you, because I assume that anyone who are interested in oil shocks and related issues read your paper and realize the importance of that thing. So Dr. Lutz Kilian is currently working as a senior economic policy advisor at the Federal Reserve Bank of Dallas. And before joining the Fed, he's was a professor of economics in the University of Michigan, and he has been working in many international organizations like in the European Central Bank, International Monetary Fund, and others. A lot of things that I want to list them all. Academically, he's also served as associate editor for the Journal of Business Economic Statistics, Journal of Development Economics, and Journal of Economic Dynamics and Control. He has published so many papers, but I think the most well-known, I think is the most cited research is the one in 2009 in the American Economic Review. Not all oil price shocks are alike. I think this is the one that myself, I read it many times and actually used the index in my research. And I think many of the audience today also read and used the three oil shocks matters, so the supply shock and demand shock and oil specific shock. So this is really the most influential works. And today, Professor Kilian is going to bring us a very interesting work he's done recently, the impact of rising oil price on US inflation and inflation expectations in 2020 to 2023. I think we all realize the importance of oil shocks recent years. I think we actually feel the oil shocks since the Ukraine-Russia conflicts, because the oil price, the the petrol price in China at the moment is 10 yuan per liter, so which is quite big numbers. Like it's about 30% rise during a year period. That's a lot of impact. And also we all realize in recent days and the inflation in most of the countries across the world, in Europe, is around 10%. Some of the countries like Turkey is around 80%, something like that, which is quite a lot of new things happening. And so I think the topic and the work here is really very updated. So we really want to hear a lot more information from Professor Kilian. So I don't want to spend too much time now, so I'll pass the room to you, and you have 1 hour, and then we'll have question time. All right, this is all yours.
Thank you for the introduction. I'm actually going to draw on 2 recent papers, but then add a bit more insights from a policy point of view about recent events and the global economy and how they affect inflation and inflation expectations. This is based on joint work with Xiaojing Zhou, also at the Federal Reserve Bank of Dallas, and the usual disclaimers for work done at the Federal Reserve apply. It's well known that survey data of household inflation expectations may differ systematically from professional inflation forecasts. And one possible explanation for this fact is that household inflation expectations are more responsive to fluctuations in the price of gasoline than are professional inflation forecasts. And intuitively, that idea makes sense because among all the prices that consumers see in daily life, there is no price that's more visible than the price of gasoline, because everybody who commutes to work is going to pass by several gas stations on the way. And so, yeah, you may or may not know what the price of milk is, but the price of gasoline, everybody basically sees. Now, this point was forcefully articulated in a widely cited paper by Koibian and Gornichenko that came out in the AJ Macro in 2015. They concluded that almost all of the short-run variability in household inflation expectations is explained by changes in the level of the price of oil and hence in the price of gasoline. And this view has really become part of the mainstream. Over the years, people take this as a well-established fact. So an obvious question is, well, how did those guys reach that conclusion? And they actually provide a number of different results based on different data, different estimation periods. But the single most important piece of evidence is obtained from data from quarterly data for 1981 Q3 to 2013 Q1. Here I'm reproducing that result in the upper panel shown in yellow. And what they did was to start by observing that if you look at the spread of household inflation expectations 1 year into the future relative to professional inflation forecasts 1 year into the future, and you look at the correlation of the spread variable with the dollar price of oil, they use the West Texas Intermediate price of crude oil, that correlation is quite high. It's about 78%. They then show that if you run a regression where you regress this spread variable on a constant and the oil price, you're going to get a t-statistic with an astounding value of 13 and an R-squared of 61%. So that all looks as though there is a fairly tight statistical relationship. It turns out that if you look at some of the other estimation periods that they looked at in the second and third column, or if you update the data they used, as shown in the last 2 columns, that type of result is very robust. You basically get very similar results for all of these specifications. There's only one thing that might seem slightly awkward about this, which is that the story I just told you, the story they're trying to sell you, is all about the relationship between household inflation expectations and the oil price. So why is it that they give you regressions where the household inflation expectations is normalized relative to professional inflation forecasts? That seems a little bit odd. And if you read the paper carefully, there's some discussion of that fact in the paper where they say, look, we think we know that professional forecasts of inflation are not sensitive to the oil price. They're basically like a constant. And so whether we include this or not doesn't make any difference. Well, it's better to check that. And that's what's done in the lower panel. So if you look at the continuation of the first yellow column, I'm now looking at the same type of analysis, except I'm only looking at household inflation expectations. And what you see is that the correlation that used to be 78%, in that case, drops to 11%, which is far less impressive. And the t statistic that used to be 13 now becomes 1. And the r squared that used to be 61% now drops to 1%. So it would be fair to say that there is no apparent evidence of a close statistical relationship between oil prices and household inflation expectations, which happens to be the exact opposite conclusion of Koivian and Korodnichenko. There's another interesting fact here, which is when you look at alternative estimation periods, for example, focusing on the correlation metric, the correlation results are extremely non-robust to changing the estimation period. In fact, they may be as low as 4% in the second to last column, or as high as 74%, depending on which estimation period you look at. And Koivian and Korodnichenko actually talk about one of those results. They report that 74% result and saying it's very similar to the 78% here. Well, that is not true for any of the other estimation periods. So clearly, there doesn't seem to be much empirical support for the key empirical result in their analysis. So that leads me to having a closer look at this, a more systematic look, starting with a model where we throw out the survey of professional forecaster data and look at inflation expectations of households and relate that to OT, the WTI price of crude oil expressed in nominal dollars. Now, under the null that these two variables are uncorrelated, the beta coefficient in this regression should be equal to 0. That can be tested using a t-test with robust critical values. And if you do that, and so here I'm going to show you results based on monthly data, whether you do quarterly or monthly actually makes no difference. And I'm going to show you results that use data only starting in 1990. That is because the evidence becomes weaker when we include earlier data as in the original analysis. When you do that, you're going to get a correlation of 29%, not very impressive, an R squared of about 9%, and a t statistic of 1.8. So nothing here suggests that there is a tight statistical relationship. But there are a number of other concerns you might raise about this kind of regression that we need to look at more closely. The first is, why is it that we're working with the oil price in levels, in dollars, and not the oil price in log levels? Now, it's certainly true that if you go to a gas station, the sign at the gas station is going to express the price of gasoline in dollars and cents. But that doesn't mean that households change their inflation expectations proportionately to changes in the gas price in dollars and cents. A much more natural thing would be to say, well, if inflation is the percent change in the overall price level, and if I take changes in the gas price to be my measure of what's going on with the overall price level, I would want to compare the percent change in the gas price and take that as a proxy for the percent change in the overall price level. Now, a reasonable premise here is that if a consumer is looking at an increase in the gas price from $1 to $1.05, which is a 5% increase, then presumably you would respond more strongly than if you see the gas price go from $4 to $4.05, because that's only about a 1% increase. If you think that's an appealing argument, you ought to be working with a log specification for the regressor. That is, it should be the log price of oil or the log price of gasoline on the right-hand side, not the dollar price used by Koivian and Korodnichenko. So what happens when we switch to the log specification? Well, it turns out our already low 29% drops to 20%, the R squared drops down to 4%, and the t statistic goes to 1.25. So the results become even weaker. Here's the second concern. Why is it that we're using the oil price as a proxy for the gasoline price? Because that's not obvious, because the essential argument in Koybin-Gornichenko's paper is that households pay particular attention to prices they see more often when they form the expectations of future inflation. And that's true for the gasoline price, but it is definitely not true for the price of crude oil, because no consumer in the world in history has ever bought crude oil. People buy fuel, right? They don't buy crude oil. And that means if you stop a random consumer on the sidewalk and ask them, what's today's price of crude oil? They will look at you blankly because they have no idea. So what happened to the story that the reason consumers care about these prices is that they're very visible? That doesn't apply to the crude oil price. It only applies to the gasoline price. So why are we not using the gasoline price? Well, you can try to rescue the idea of using the oil price here if you're willing to assume that changes in the oil price are the only source of changes in the gasoline price and that they're being passed on proportionately. Now, if you were to talk to experts on oil and gasoline markets, they will immediately tell you that that's not likely to be a good assumption. But there is an easy way of settling that debate, which is to say, look, we can redo the regression with the gas price taking the place of the oil price. If the oil price is a good proxy for the gas price, the results should be very similar. And if they're not similar, it tells you that the gas price is the right way of going. So here we have the results. And so I'm going to focus on the last column now, which is looking at the log level specification of the gasoline price, and compare that to the first column, which was the original baseline result. What do we get? The correlation drops from 29 to 15%, the R squared from 9 to 2%, and the t statistic from 1.8 to 0.8. So the results get even weaker. So in other words, it's really the gas price you ought to be running this regression with, not the oil price. Now, there's a third concern, which is that in Koybin and Gornichenko's paper, they use normal 0-1 critical values to judge whether there is a statistically significant correlation between the oil price and expectations. It turns out that's not a good idea. It's not a good idea because the dependent variable in the regression here is inflation expectations, which is plausibly I0. But the regressor, the oil price regressor, is clearly I1, or maybe a nonlinear transformation of an I1 variable, meaning a unit root variable. That means the orders of integration of the dependent and the independent variable are different. That makes the regression unbalanced. And that means that the distribution of the t statistic may be far from normal 0-1. In particular, when the dependent variable is positively serially correlated, which is most definitely the case here. There is an econometrics literature that has established that point. And so that means we got to be really careful when we try to conduct statistical inference. So how are we going to solve that problem? Well, one way of doing this would be to write down a data generating process under the null hypothesis that beta is equal to 0. That can be accomplished by postulating that inflation expectations follow an autoregressive process with Gaussian innovations, and that the log nominal price of oil follows a random walk with fat-tailed innovations and possibly a drift. When we fit those two regressions to the actual data, it turns out the drift is essentially 0. It can be ignored. And we can then generate from this fitted process as many replications of the data of the same length as the original data as we like. For each of those, we can run the regression of inflation expectations on a constant and beta times the oil price. And we can build up the empirical distribution of the t statistic under the null. And the same thing can be done with the gasoline price. This is what you get. The dotted red line as a reference is the conventional normal 0-1 distribution. The distribution shown in blue, that is the non-standard finite sample null distribution that we ought to be using. What's the difference? Both distributions are centered on 0, but the blue distribution is much more fat tail. It moves probability mass from the center of the distribution to the tails. That implies if you were to use critical values coming from the red distribution, you would be rejecting the null much more often than you should, concluding that there's a statistically significant correlation, when in reality, there may be not. Now, I can use the finite sample distributions to compute the finite sample p-values for the 4 regression specifications we've discussed so far, and it turns out that in no case can we reject the null of zero correlation at the 10% level, and the more realistic we make the regression, the harder it gets to reject. So this says there is absolutely no evidence supporting the central result in Kilian and Gordinichenko. Now, you might say, if we are convinced now that the log level of the oil price and the log level of the gasoline price are I1, then maybe it would make more sense to regress inflation expectations on the growth rate of the oil price or the growth rate of the gasoline price, because then we get a standard distributional result for the t-statistic. Life is easy. We can do that, and we get highly significant results in that case. However, the correlations are smallish, and the R squared of that regression is between 2 and 6%, which is very different from the 78% correlation reported in Kilian and Gordinichenko. In other words, the statistical relationship is extremely weak, and it's not clear in any case whether that statistical correlation means that there is causation. So the punchline here is that neither static regressions nor reduced form correlations are the appropriate tool for understanding the empirical relationship between oil and gas prices on the one hand and inflation expectations on the other. So in the second part of the paper, we instead introduce a structural vector autoregressive model to try to disentangle the relationship between the real price of gasoline, headline CPI inflation, and household one-year inflation expectations. Note that as in Kilian and Gordinichenko, what we're doing is explicitly behavioral. That is, we're trying to measure the response of household inflation expectations to unexpected changes in the nominal price of gasoline. That's a behavioral relationship. We're trying to quantify that relationship. What's nice about the SVAR model is that it also accommodates alternative economic interpretations of this behavioral relationship. And that helps us better understand whether the results make economic sense. The advantages compared to static regressions is that we account for the endogeneity of the real price of gasoline. We relax the dynamic restrictions, because in a static regression, you implicitly assume that all the feedback from oil or gasoline prices to inflation expectations occurs within a month or within a quarter. Well, that may not be the case. We can actually quantify the cumulative effect of nominal gasoline price shocks on household inflation expectations and inflation, which is going to be really useful to address the related debate about the expectations of augmented Phillips curve. And we can show that our results are robust to various changes in model specification and in the identification, and they're also robust over time, whereas static regressions are highly non-robust, and that can be shown to be related to this unbalanced regression problem. So here's the baseline model, very simple, 3 variables: the log level of the real gasoline price, headline CPI inflation, and the corresponding Michigan Survey of Consumers measure of households' one-year mean inflation expectations, the same expectations variable that Kilian and Gordinichenko used. We're going to set the upper bound on the lag order to 12, and we're going to make the following identifying assumptions. There are 3 structural shocks here. The first one is a nominal gasoline price shock. It's important that this be nominal, because what you see at the gas station is the nominal price, obviously. When we have a positive gasoline price shock, what is that doing? Well, it's raising the real price of gasoline on impact. That's true because by construction, the overall CPI responds more slowly to this shock than the nominal price of gasoline. It also raises household inflation expectations. That is coming from household level evidence in a paper by Binder 2018. When we have a positive shock to the core CPI, which here is defined as the CPI excluding gasoline prices for our purposes, that also raises consumer price inflation and inflation expectations consistent with Binder's evidence. It will also lower the real price of gasoline on impact, and that's a direct consequence of the evidence in Kilian and Vega that nominal gas price shocks don't respond within the same month to inflation shocks. And finally, we allow for idiosyncratic inflation expectation shocks. What are those? Well, basically, they reflect fears of inflationary pressures that are not yet reflected in current prices. Right? So it might be something that you read in the newspaper or watch on CNN, and that makes you very nervous, but that's not currently reflected in the prices you pay at the grocery store. So taken together, these assumptions gives us a set of inequality and zero restrictions on the structural impact multiplier matrix that links the vector of reduced form residuals to the corresponding vector of structural errors. This kind of model is estimated by Bayesian methods using a uniform Gaussian inverse Wishart prior, building on work done in a recent econometrics paper by Arias et al. For the reduced form prior, we're using a conventional Minnesota prior with zero mean for the slope parameters. It can be shown that this prior is uninformative for the vector of structural impulse responses and is not driving our results. When we have constructed the posterior distribution of the structural impulse responses, we evaluate this joint posterior distribution under additively separable absolute loss, as discussed in recent work of mine with Atsushi Inoue. Here is the set of impulse response results. There are two things here. One set of results here are the black lines. The black lines give you essentially the base estimate of the set of impulse responses. The red lines give you a visual approximation to the corresponding 68% joint credible set. I'm going to focus my discussion on the second row, which shows the responses to a 1 standard deviation nominal gas price shock. What does that do? It gives you a persistent appreciation in the real price of gasoline. You get on impact an upward jump in headline CPI inflation, which comes down after about 2 months and then is indistinguishable from zero. And finally, you get an increase on impact that lasts for about half a year in household inflation expectations. And that last result is actually the first time in this literature that someone has established formally that gas price shocks are moving household inflation expectations. So that's good. Now, another way of representing these results is by constructing the counterfactual for household inflation expectations of how those expectations would have evolved if there had been no nominal gasoline price shocks. And that can be done essentially with the historical decomposition. The counterfactual here is shown in red. The actual expectations data is shown in black. The vertical distance between those two lines measures the cumulative impact of gas price shocks. And what you see is, for example, that there was a big spike in about mid-1990. That's the invasion of Kuwait, which drove up the black line way above the red line because there were positive oil price shocks and therefore positive gas price shocks associated with that event. What this is saying is, if it hadn't been for that invasion of Kuwait, well, inflation expectations would have been quite a bit lower. For example, if you look at the Asian crisis in the late 90s, it's saying without the Asian crisis, which lowered commodity and oil prices and therefore gasoline prices, inflation expectations would have been quite a bit higher than what we actually observed. You also see discrepancies during the big surge in oil prices in the 2000s. You see a very nice discrepancy in 2015 when the oil price and the gas price collapsed, where the actual inflation expectations are quite a bit lower than they otherwise would have been. And you see the widening gap at the beginning of the pandemic recession. So all of this makes intuitive sense. Now, how important is this on average? Well, if you look at a variance decomposition based on the estimated model, one can show that only 42% of the variation in one-year household inflation expectations is explained by gas price shocks. Why is that important? Well, if you read Koybin, Gornichenko, they told us that nearly 100% are explained by gas price shocks. We find only 42%. That's quite a bit of a difference, right? And so that shows that being formal about the econometric framework here helps you quantify these effects. Now, there are people who look at 42% and saying, wait a minute, we thought 100% was crazy, but even 42% is too high for our comfort. The response to those people I would have is that you can show, we do that in the paper, that gasoline price shocks in this model tend to capture domestic aggregate demand shocks. And from that point of view, it's actually quite sensible that a fairly large part of variation in inflation expectations is explained by gasoline price shocks. Now, let me be clear, what we're not saying here is that households are sitting there running models that disentangle demand and supply shocks to figure out what's going on in the economy. They're not doing that. That wouldn't make any sense. What households actually are doing, we think, is that they extrapolate from the experience of the 1970s and 1980s, when demand shocks dominated the evolution of the prices of oil and gasoline. And essentially, they're applying the same rule of thumb that seemed to work in that period to more recent data. There's actually direct household level survey evidence in support of this view. And it turns out that this is not a bad way of thinking about the real world. If you look at the financial crisis of 2008, for example, this simple rule of thumb works quite well in explaining the data. So this is a sensible thing to do for households. Now, when we submitted the paper, naturally, there were a lot of referees who wanted to be convinced that these results are robust. So they made us do a fair bit of work. So here's a quick overview. One thing we did is we designed an alternative, partially identified structure model. Partially identified means only one shock is identified in that model. That's the gasoline price shock. What's the difference to the previous model? Well, the first variable now is the percent change in the nominal gasoline price. And the only restrictions we need are these two zero restrictions, which come from the evidence in Kilian and Vega. That allows us to dispense with all the other identifying assumptions we had earlier. And when you run this model and look at the results, they look exactly like the ones that I showed you earlier. Nothing changes. We also did some robustness checks, dropping the sign restrictions on inflation expectations in the baseline model. That didn't affect the key results. We replaced the mean expectations by median expectations. That made no difference. We verified that the model is temporally stable. We showed that if you add a measure of economic slack, the results are not affected. So basically, everything here is very robust. And we even showed that our analysis is substantively different from earlier work in the JMCV by Benjamin Wong in 2015, who looked at the link between crude oil prices and US inflation expectations. It turns out that the results are not the same as our results because the distinction between oil and gasoline prices matters. Now, at this point, I want to switch gears and talk more specifically about oil prices as drivers of inflation. Why is that? Well, there has been, as you all know, a surge in US inflation in recent months, which has renewed interest in the question of what role rising oil and gasoline prices have played in raising inflation rates. You see that when you open a newspaper and there's a lot of discussion where people say, well, the reason we have high inflation is rising gas prices. Well, is that true? Well, we'll have to see. There's a related question, which is what impact rising fuel prices have had on household inflation expectations. The reason why people are concerned with that question is that inflation expectations may become unanchored when households face shocks, and that could give rise to wage price spirals, which are an obvious concern from a policymaker point of view. In fact, some politicians view high gasoline prices as evidence of price gouging and propose to tax the excess profits of oil companies in order to deal with high inflation. So I'm going to say a few words about that as well. These are the key policy issues in particular in recent months and years. To understand why we're talking about this, have a look at this picture of the 12-month US headline CPI inflation rates. So what stands out are these two big spikes in the headline CPI inflation in the early 70s and late 70s. When you look at the far right, you see what looks like the beginning of another big spike of a comparable magnitude, perhaps, that happens at the end of the COVID recession. And so the obvious concern is, well, why is that happening? To what extent is that linked to gasoline prices? Is that perhaps similar to what happened in the 1970s? So a good starting point here is to look at the daily price of West Texas Intermediate crude oil. Here we have data from January 3rd to June 17. Now, the invasion of the Ukraine happened in late February. But what this picture shows you is that well before that, and extending into 21, the oil price had been steadily drifting upward. Why is that? Well, we have a world where there is robust demand for oil. The supply responses to these rising prices has been quite muted, quite sluggish. And so it's not surprising that there is something of a trend of rising oil prices in the data, even before the invasion of Ukraine. When that invasion occurred, the price quickly went from about $93 to a little bit over 120, and just as quickly came back down. And since then, we've been basically on a roller coaster ride where prices go up and down, up and down, up and down. Why do we have this additional volatility in oil prices? Well, intuitively, because market participants have a hard time reading the fundamentals. And that means every little piece of news makes people nervous and move in one direction or another. And it's almost comical to read the headlines about why the price went up or down, because the stories are completely different day to day. Or in fact, even the same, where they talk about the same thing driving the price up or down. So what we see here in essence is that there is a continuous upward trend, which is consistent with things that have nothing to do with the Russian invasion of Ukraine. You see a lot of excess volatility after starting with the invasion of Ukraine, and the average increase relative to trend in the oil price has actually been quite modest. So that's kind of the background. So how do these oil price fluctuations affect consumer prices? Well, there you have to keep in mind that consumers don't buy crude oil, they buy motor fuel. Why does that matter? Well, in the US, the cost share of crude oil for gasoline and diesel tends to be somewhere between 50 and 60%. What that means is that if you face a 10% increase in the oil price, that translates only to a 5 or 6% increase in the fuel prices that enter the CPI. So that distinction matters. So here's some recent evidence from daily data, where the first 3 bars show you the cumulative increase starting with the day before the invasion of Ukraine up to the peak value in oil and other energy prices. So the blue bar, for example, tells you that over this period, the WTI price went up about 35%. The gray bar tells you that the spot price of gasoline in New York Harbor, that's essentially the price coming directly from the oil refinery, went up about as much as the oil price. That makes a lot of sense. Yet the cumulative increase in the retail gasoline price is only about 60% of that. And that is exactly consistent with what I told you on the previous slide. That's what you would expect. It shouldn't move proportionately, and shouldn't move 1 for 1 with the blue bar, only proportionately with this 60% fraction. And that's what we're seeing here. What I'm also showing is the cumulative change from the peak value of each of these prices to April 13. You see a similar decline in blue and gray, but you see a much smaller decline in red here. That is, the cumulative decline in the retail price of gasoline is not 60% of the cumulative decline in the blue line, indicating some form of asymmetry. And so there is a literature where people talk about the price of gasoline going up like a rocket in response to rising oil prices, and coming down like a feather in response to falling oil prices. That's supposed to capture this kind of asymmetry. Of course, there's a lot of discussion, and people have accused oil companies of not passing on their oil price savings. That doesn't make much sense, because the fact is that almost none of the retail gas stations in the US are owned by companies that produce oil, which means the oil companies don't control the price at the gas station. That's just not the case. That is being set by the retail gas station owners who run their own business. So why would there be an asymmetry? So one traditional story has been that when the price of oil goes up, when the price of gasoline goes up, then consumers very actively search for less expensive gas at other gas stations. And that prevents the price from going up further. When the price of gasoline comes down, in contrast, people are not nearly as actively looking for even lower prices. That gives additional market power to the owners of retail gasoline stations. They don't have to lower their price quite as fast, and that gives you some form of asymmetry. The problem is that this kind of effect tends to happen in the short run. It washes out once you're talking about a horizon of a month or longer, so that's not what's going on here. An alternative argument is that going back to the rising oil price volatility after the invasion of Ukraine, that the owners of gas stations, which face very tight profit margins, are concerned about not being able to pay for the next delivery of gas for their gas station if they charge a price that is too low. That means if there's additional volatility in the oil price, they're going to charge a premium, and that premium is going to make that decline here small. Is that the main explanation? Not either, I don't think so. The most important explanation for this apparent asymmetry is much simpler. During this time period, for the bars on the right, there were major refiner outages, in particular in California, which prevented gasoline prices in the Western United States from going down. Since this is a national average that is reflected in these data, if it weren't for that effect, you would see much more of a decline. In fact, if you look at data at the city level for Philadelphia or for Dallas, you see a very symmetric response. If you look in one for Phoenix or San Francisco, you don't. And so this really is not a true asymmetry. We're seeing here the transmission, at least at the monthly horizon, is actually quite symmetric. Now, let's take this and work with an extended VR model, which includes the percent change in gasoline prices, both headline and core CPI inflation, where here I'm working with a conventional definition of core, and 1 year and 5 year household inflation expectations from the Michigan Survey of Consumers. The model is going to be monthly with 12 legs. If you're going to work with a block recursive model with only the nominal gasoline price shock identified, and the estimation starts in 1990 because 5 year inflation expectations data are not available earlier. So what do we learn from this? Well, if you have a gas price shock, a one-time gas price shock, this causes a blip in the CPI inflation rate for about 2 months. After that, the response is indistinguishable from zero. The same indistinguishable from zero result holds when you focus on core CPI inflation. Why is that important? It's telling you there is no evidence for important secondary effects of gasoline price shocks on inflation. When you look at household inflation expectations, and that's the two entries on the right, you see clearly a response in 1 year inflation expectations, hardly any response in 5 year inflation expectations. Let me caution you here that the magnitude of these responses is actually quite small compared to the level of those expectations. So these are really very small effects. Now, of course, as a policymaker, we're not so much interested in what happens in response to a one-time gasoline price shock. We're really interested in what happens, what the cumulative impact of gasoline price shocks is on various measures of inflation. Here I focus on 12-month inflation rate with different colors denoting different inflation measures. Let's start with the black line. That's the contribution of gas price shocks to headline CPI inflation. You see that in early 2020, when the pandemic started and gas prices fell, we saw a big decline in that component of inflation, then a gradual recovery. And by March of 22, which is this vertical blue line, which is the most recent historical data that I use for this analysis, the contribution of gas price shocks to headline CPI inflation was about 1 percentage point. Now, the actual headline CPI inflation rate in March 22 was 8.6%. So this is saying 1 percentage point out of the 8.6 came from gas price shocks. In other words, 7.5 percentage points did not come from gas price shocks. They came from supply chain bottlenecks, wage pressures, etc., all the other things. This is saying gas price shocks actually have been a sideshow in the inflation discussion. And so that's very different from the conventional wisdom that this is all about gas price shocks driving up inflation. That's just not supported by the data. The next thing I did in this chart is to postulate that for the rest of 22 and throughout 23, the oil price would stay at $110 per barrel. That gives you a sequence for the percent change in the oil price, which implies a corresponding percent change in the gasoline price, which can then be used with the structural model to recover the sequence of structural shocks needed to make this happen. And when you feed that back into the model, you can simulate the future. And what you get is a rising component of headline CPI inflation driven by gas price shocks peaking in early 23 at about 2.4 percentage points. Note that the measure of inflation is important, because if I do this for headline PCE inflation, well, then that peak in early 23 is only 1.4, not 2.4%. And if I'm interested in core CPI or PCE inflation, I'm reaching about half a percentage point roughly at the end of 23. So again, very different. So this picture may seem to suggest that there will be rising inflationary pressures from gasoline price shock. That's actually not the case. That's an artifact of the construction of 12-month inflation rates. If you look at the month-by-month inflation rates for headline CPI inflation, you see that there's a big spike in March, but that's already historical data. That's already behind us. For the rest of 22, we see inflation rates contributions of roughly 2 percentage points at an annualized rate going back down to 0. So that's quite modest. If you look at inflation expectations 1 year out, you're going to get an increase point estimate of about 0.6, 0.7 percentage points, but very imprecisely estimated. For 5-year expectations, there's hardly any effect at all. So that's telling you that you don't need to worry about wage price spirals being caused by gasoline price shocks in this context. Okay, now in this scenario, you may have noticed that I assumed the price at $110. I didn't talk about Russia and the invasion of Ukraine and oil supply shocks and all of that. So let me fill in some of that. Russia produces or has produced till February of this year about 11 million barrels a day of oil. About 5 million of that is being exported directly as crude oil. Another 3 million barrels a day is being exported as refined products after having been refined in Russia. And 3 million barrels a day are used up domestically in Russia. So the contribution of Russia to world markets is about 8 million barrels a day, quite a bit. It's one of the bigger oil producers out there. So when we think about a potential disruption of that production, the obvious question is, could that be made up elsewhere? And the short answer is not really. And there's every reason to believe that in the foreseeable future, oil production elsewhere in the world is quite inelastic. Let's fill in some of the details. So what about OPEC? Well, it turns out most OPEC members did not invest in additional production in recent years. And at this point, it's mainly Saudi Arabia and the UAE that have spare capacity left, and not even that much. That means it would be very difficult for OPEC to raise oil production a lot. And on top of that, Saudi Arabia is not likely to upset its cooperative equilibrium with Russia, because they paid a high price to establish that cooperative equilibrium. And therefore, we would not expect Saudi Arabia to increase oil production a lot. In fact, when you look at the announcements OPEC has been making about how much they plan to increase oil production, there's a growing gap between what they say they're going to pump and what they actually pump. What they're actually pumping is much, much less than what they say. And so you see more and more announcements, they're going to increase their production, but we know it's not going to happen. What about US shale oil? Well, the first point to keep in mind is that investors in the US shale oil sector are resisting higher oil production growth. The sector is generating fairly high profits at this point because oil prices are much higher. Investors want to be paid out, they want to receive those profits rather than plowing them back into additional production. And they have been criticized for that, but it's important to understand why what they are doing actually makes a lot of sense. Investing in the oil sector is risky business, which means you may invest your money and there's a good chance you're going to lose money. In fact, those same investors have been losing money for about a decade, every year. Now they're finally making profits, and from their point of view, this is just compensation for all the losses they made in earlier years that nobody cared about. Because in order to justify investing in the oil sector, you have to generate a required rate of return on average in the long run, right? And so having these high profits now is necessary. Now, if a policymaker were to come in and saying, oh, we're going to tax those guys, we're going to take away their profits, you can do that. But what would the investors do? They would say it doesn't make sense to invest in the oil sector under those circumstances. And the net result would be a decline in oil production rather than an increase. Now, suppose that the oil price were to rise enough for investors to change their mind. It turns out, even in that case, we wouldn't expect much more production because oil producers face supply chain bottlenecks, labor market shortages, and high cost inflation. So if you want to order, for example, additional steel pipe, which is needed to increase your shale oil production, you can talk to your supplier, but they will tell you that maybe by the middle of 23, that steel pipe will become available. So if you don't have steel pipe already, you're not going to increase your production. Many experienced workers have left the oil sector during the pandemic, and they're not coming back. So there are huge labor market shortages in the shale oil sector, and the cost of standard inputs like sand are going up at the rates of 20%, in some cases 40%. So there is high cost inflation, all of which makes it physically impossible to generate large increases in shale production in the short run. There's an additional complication, which is that the quality of wells has been declining. And that means you now need to invest more to achieve the same level of output than was the case in the past. And there's a final point I want to raise, which is that shale oil is ultra-light sweet crude oil, which is not a good substitute from a refiner's point of view for heavy sour Russian crude. So even if you crank up production of light sweet crude, the refiners that traditionally have used heavy sour Russian crude couldn't use that oil. And so it really would not address the problem. The Biden administration, I'm sure, is aware of this, which is why they have been talking to Venezuela and Iran, who produce oil that is much more similar in quality to Russian crude oil than shale oil. The problem is that Venezuela has been expropriating foreign oil companies for too many times, and there is no appetite for companies to go back and try again. For Iran, if it ever came to a new nuclear deal with Iran, which is not clear, the long period of underinvestment in Iranian oil production means that a recovery would be quite slow. So none of those sources of oil is likely to generate big increases. So we don't have data for the recent period on Russian oil production because that's obviously a sensitive matter under the current circumstances. But we do have data on Russian exports of crude oil by tanker in 22 for the first 5 months. So the results I'm showing here are from tanker trackers, and they're normalized relative to the January 2022 level. So a positive number, it would indicate an increase, a negative number, a decrease relative to January. And so what you see is that in February and March, Russian oil exports were pretty stable. Remember, the invasion started February 24. But in April and May, Russian exports actually increased quite substantially. And that's not a measurement issue because at this point we can track down where the oil goes, and most of it is going to known destinations. So this is the opposite of a decline in Russian oil exports. It's an increase in Russian oil exports. Where does it go? Well, a good chunk goes to China, as shown here. An even bigger chunk goes to India. Talking about China, I looked at Iranian and Venezuelan oil exports to China. They're a bit choppy here. Then you see a big decline. Other oil exports to China actually were pretty big, but gradually went down. That decline here is a little bit difficult to interpret. It could be that there is some substitution between oil from other sources and Russian oil going on, but it could also be a general decline in oil imports now that storage is starting to fill up and the demand for oil from the Chinese economy is declining. So it's not completely clear how to interpret that. What about Russian exports to other destinations? Well, what about US, Canada, Japan, and South Korea? You see very clearly that these countries have reduced their imports of Russian oil. When you look at key European destinations, it's a lot less clear. In fact, it goes up and goes down, but mostly it goes up. And when you look more carefully, there actually are European countries that have reduced their oil imports from Russia, but there's some others. Italy comes to mind that have actually greatly increased their imports of Russian crude oil. So it'll be interesting to see what happens as the EU embargo takes effect by the end of the year. Presumably, we'll start seeing a decline. So to summarize, Russian pipeline and seaborne crude oil exports have remained robust, if not increased. There have been some effects, however. One has been a decline in Russian product exports in April. There's also been a decline in domestic fuel demand in Russia. For example, people don't fly as much anymore as they used to. That proved to be important because it forced some Russian refiners to cut production runs, essentially because they ran out of storage for putting the jet fuel and diesel and other things they were producing, given the reduced demand for fuel. That in turn forced some Russian oil producers to reduce their production. And in April, Russian oil production dropped about 8%. Now, for May, we don't have hard data, but it looks like there's going to be a gradual recovery in May. Be that as it may, this is an indication of a quite small oil supply disruption in Russia. And that makes perfect sense when you remember the data on oil prices I showed you earlier, because the increase in oil prices has been quite modest, consistent with a small oil supply disruption. So that's what's been happening so far. Of course, given the EU embargo, we know that up to 2.5 million barrels a day of Russian petroleum exports are at risk of being shut in by the end of 22. How much that really is going to be, and could be a lot smaller, of course, will depend on Russia's ability to reroute tanker exports to Asia. That's kind of the key unknown here that will determine how big this effect is going to be. The concern is that once oil production is shut in, that, in particular, when you talk about conventional oil production, is likely to damage wells permanently even, and makes it very difficult to restart them, especially without foreign technical assistance. And that means we could be looking at a persistent decline in Russian oil production if it gets to the point where they have to shut in crude oil production. So where does that lead us? I would argue that we likely have only seen the beginning of this oil supply shock. Given inelastic oil production elsewhere in the world, and given inelastic gasoline demand in the short run, it will require a substantial oil price increase to bring global oil consumption down to match available production. Unless, that is, a number of things happen. One possibility would be that the global economy slows down for other reasons. If, for example, China, because of strict COVID policies, were to go into a decline in economic activity, which also would have repercussions for the rest of the world through supply chain dynamics, that would reduce the demand for crude oil and would alleviate this concern. If Russian oil deliveries could be successfully redirected to Asia, that would clearly alleviate this concern. The concern here is, where do we get the tankers from? It turns out that's not likely to be a big problem at this point. The other concern is, where are we going to get the insurance for those shipments from? And that's a little bit less clear. The Europeans have made insurance services part of the EU embargo. The question is whether Russia and importers of Russian oil in Asia will find creative ways of substituting for that insurance in order to be able to greatly increase the amount of oil that they're already importing right now. That really is going to determine how big of an oil price increase is required for the market to clear here. And I would argue that between a gradual oil production increases elsewhere in the world, a slowing global economy, also think of the United States with the possibility of a hard landing, and an EU embargo that is likely only partially effective at reducing Russian exports, there is a chance that dramatic oil price increases, global oil price increases, can be avoided, but we don't know that at this point, right? It all depends on the ability to reroute that Russian crude oil, in particular, to Asia. So the last point I want to make here is that I've been talking a lot about the inflationary impact of the war as it operates through oil and fuel prices. But that's, of course, only part of the story, because we know that there is a shortage of natural gas, in particular in Europe. And we know that LNG trade is going to transmit, at least gradually, those natural gas price increases to other countries, adding to inflationary pressures. We also know that there is a shortage of industrial and food commodities, given that Ukraine is a big producer of steel, for example, or of wheat. That's going to feed into inflationary pressures. And we know that there will be additional global supply chain disruptions that are quite different from the supply chain disruptions that we have been talking about for the last couple of months, and that will again have an inflationary impact. So the overall impact of the geopolitical event of the invasion of Ukraine, that inflationary impact is likely to be bigger than what would be indicated by the estimates that I presented earlier. So let me stop here and we can open the floor for questions.
Okay, thank you very much. That's very interesting talk, and there's a lot of issues there in the oil market. I think in the recent 2 years, I mean, people in China, for example, have never been paying so much attention to oil prices. I think it comes way before, just like the picture you show, that the oil price went up way before the emission happened. You know, it's, for example, you know, what we had attention from China has happened, you know, in the early 2020, when the pandemic started to shock the world, and we observed that negative shock from WTI, negative oil price. So everybody started to pay attention to crude oil. So originally, people has no idea what oil is, what's the difference between crude oil and gasoline. But now, when we realize the importance of that, and people started to pay attention on that. But this is the issue here, and obviously, from household, because you mentioned about household expectation on inflation, but from household perspective, I think most people pay attention only when the price goes extreme movements, like negative price, or it's like you've shown in a later stage when the invasion happens, this price goes up, extreme movement happening in price. So what do you think when we look at, you know, when we look at empirical models looking at the relationship between oil shocks and inflations and many other issues? So we don't really look at the extreme price, but in fact,
so you're certainly right that negative prices for oil in particular were getting a lot of attention. Of course, technically, these were futures prices, I guess to some extent also spot prices at the end of the day. From the point of view of a consumer in the United States, for example, of course, it wasn't the case that the gas price or the diesel price at the gas station were negative. Quite the opposite, right? They were just what they were the day before. And so the fact that the futures price turned negative was, I guess, at some level, a regulatory failure, because as I'm sure you know, retail customers in China engaged in trading in this contract at a time when professional traders had long moved out, because as you may know, these oil futures contracts are rolled over at certain parts in the middle of the month. And that means that a few days before they're rolled over, all the professional guys go out. And it was at that point that those Chinese retail investors started entering the market. Now, in the US, that would be illegal, right? Because in order to protect the retail investor, they're not allowed to be in this kind of professional market. And I think some Chinese financial institution had some app that effectively allowed retail investors to get in. And they looked at the data and interpreted it incorrectly because they didn't understand the liabilities associated with futures contracts. And when they got stuck with those contracts, they had to sell them at the end because the oil has to be delivered physically and someone has to be paid to take the oil. That means at the end of the day, you pay to get rid of the oil that you just bought. And that's where the negative price comes from. So I don't think that that affected inflation expectation, at least in the United States. Because for one thing, people have a hard time understanding what a negative price is. It sounds surreal. And second, more importantly, it didn't affect anything in real life.
Okay, thank you. Floor's open now, so I think you can, the audience, if you have questions, please. For people who find difficulties to talk, and you can also type your questions in the chatting room. That will be another way to communicate with Professor Kilian. Okay, I think I've got one question from the chatting room from Asher.
Can you read the questions in the chat? That might be easier.
Yes, I will do that. Yeah. The pump price is $5 per gallon in the US, which is equivalent to $150 per barrel. The implied crude oil price, the New York NYMEX WTI price is 110 BBW for now. How to explain the disparity between the implied crude price and WTI crude price?
Yeah, so first, I think the causation, if any, would run the other way, right? It's the oil price that feeds into the gasoline price or diesel price, not that the fuel price feeds into the implied oil price. So that's kind of the basic story. And usually we have in mind that a certain percentage of what you pay at the pump, at the gas station, reflects the cost of oil. And if the cost of oil, meaning the price of oil, goes up, well, then you expect this to be transmitted to the gas price. That's, however, only part of the story right now, because there is a global shortage in fuel markets, in particular for diesel being related to jet fuel because of the nature of the production process at refiners, and to a lesser extent for gasoline. That shortage has many reasons, some of which are domestic, some of which are global, and some of which are specific to the events in Russia. So first of all, during the pandemic, there was an excess capacity of refineries worldwide, including in the United States. Essentially, demand for fuels was low. There were lots of refiners and they didn't make any money. They started losing money. And so the owners of refiners did what they could to either shut down some of the refiners or to convert them to special products that relied on subsidies for biodiesel or other more fashionable fuels than regular gasoline and diesel. When the economy came out of the pandemic and the demand for fuel started increasing more, this happened faster than had been anticipated by the owners of refiners. And so right now, we are having essentially a temporary refinery shortage. That is, refiners are planning to increase capacity gradually over time, but the increase in demand outpaced the ability to produce more refined product, no matter what the price is of crude oil. And that means that the co-movement between fuel prices and oil prices to some extent has broken down, has become weaker than before. And that's explaining the kind of phenomenon that was alluded to in the question. Now, the second point here is that there is a lot of demand for such fuels in Europe. That has to do with the fact that there is a shortage of Russian crude. Russian crude, as I pointed out earlier, tends to be heavy, more sour crude. That crude is particularly useful for producing diesel fuel. Diesel fuel is an important fuel in Europe, in particular for passenger cars, very different from the US, where few people have a car that runs on diesel. It's mostly trucks, really, or maybe agricultural equipment that runs on diesel. And so because there is a huge shortage of diesel and to some extent also gasoline in Europe right now, which is going to get worse through the EU oil embargo, the prices for those fuels in Europe are high. Now, the market for fuels is an integrated global market, which means if there's a high price for diesel in Europe, what are US refiners going to do? Well, they will start to export diesel fuel to Europe to capitalize or to profit from those high prices. And are they going to sell diesel for a lower price in the US? No, they're going to charge the same price by arbitrage, right? Because why would you sell diesel for a low price in the US if you could sell it for a high price in Europe? Well, by arbitrage, the prices have to be high in both directions. And that means that you have an additional reason why now in particular, the prices of jet fuel, of diesel, of gasoline are higher than they normally would be. It's really a shortage that is specific to the fuel market and not fully reflected in the oil market. So that's why you get these seemingly counterintuitive results why when you see the oil price move when it's not fully reflected in fuel prices, because fuel prices have a life of their own, if you like.
Okay, thank you. I've got another question from Chen Ji. Do you see significant increase for shale oil investment in coming years, given that it's quicker to dig and a much shorter period of revenue return?
Well, the technological improvements in the shale industry have gradually become smaller, right? So in the early years of the shale oil boom, firms got a lot better at doing their job and were able to become much more productive. I think the additional improvements in productivity are going to be relatively small. In fact, all indications are that the early wells naturally were the most productive wells, at least in expectation. Those have been drilled and have been emptied. And so if you go to new locations now, they're going to be lower quality than the original ones. And that means you're actually going to have to invest more money for the same level of oil output. And that translates to lower profitability of shale oil relatively to where we were before. So will there be additional investment in shale oil? While assuming that the price stays high enough, for sure, there will be. Even before the invasion of Ukraine, there were plans to increase oil production. It's just that the additional increase associated with the invasion of Ukraine is going to be relatively modest, certainly for this year. And then maybe we see a bit more next year. But these numbers are not going to be comparable to the very high growth in shale oil production that we saw a couple of years ago. And part of that reflects the view of shale oil producers that they don't want to rock the boat by producing too much. Part of it reflects the fact that for a long time it was very difficult for shale oil producers to raise capital. And I think there's still a bit of that, and maybe not as much as there used to be 2 years ago, because investing in oil is not fashionable. Everybody wants to invest in green energy, right? And so that has been a bit of a drag on the industry. But more generally, I think the business model has changed. Investors are much more cautious now than they used to be. So I think in general, things will be gradual.
Okay, well, thank you. Oh, I think this is really something that I related to this question when you mentioned about this. Investors are more likely to avoid investing because in the last few years, the global action against climate change leading to the actions that stop investing in the fossil fuel energy. So like China also committed to stop investing in any fossil fuel energy power plants in overseas. This will certainly, together with the shortage at the moment, will be leading to high oil price. But in the long term, I think because if energy, like in Europe, because they are switching from the fossil fuel to alternative energies. So in the long term, do you think this high oil price will sustain, or how long do you think that's going to sustain?
Well, I mean, first, in Europe right now, they're switching in the opposite direction, right? They're raising the coal power plants and bring them back in order to deal with the shortage of natural gas, for example, right? And similarly for other fuels. So there has been a bit of a revival by necessity, where people realized it's not that easy to move away from fossil fuels, something that doesn't surprise anyone in the energy sector, but that might be surprising to other people. So if you talk about shale oil, the investment horizon in shale oil is fairly short. If you drill a well, most of the production you're going to get out of the well is going to be generated over the first 2 years. In fact, it looks a bit like an exponential curve, starting very high and then coming down very quickly. That means the investment horizon in that context is about 2 years. Very different from offshore drilling, where you might have an investment horizon of 30 years, or oil sands production in Canada, which again is a very long horizon type object. So nobody in the shale oil industry is going to be worried about the transition to green technology when it comes to the question, do you invest now, right? Because nothing major is going to happen with renewables over the horizon that is relevant for that. When you're talking about offshore production, it's also interesting that if you talk to people from countries like Guyana, right, or in Latin America, if anything, their reaction is to say, well, if there is a transition to renewables coming, we better start producing now, because what we have to offer is not going to be worth that much in the long run, right? And so they're actually accelerating the extraction of fossil fuels to get the most out of it while they can, which is paradoxically working in the opposite direction. So here's my view on this. I don't think that the world is successfully going to make a transition toward renewables, electric vehicles, and all that in the foreseeable future. It is just not feasible technically and economically. That means that we're going to continue to rely on fossil fuels for the foreseeable future. So we're talking about a fairly long horizon. Now, if the economy keeps growing, which we all hope, there will be increased demand for energy. I think a lot of the additional energy demand that is generated by economic growth will be satisfied by renewables. And maybe there will be some shrinking, some slight shrinking in the provision of fossil fuels, but the fossil fuel sector is likely to be much more stable over time, for better or worse, right? I'm not saying this is necessarily a good thing from the point of view of global warming. It's just very hard to imagine how that would not be the case. And so I don't think people are going to stop investing in fossil fuels, because if you live in a place like, say, Minnesota, where it gets really cold in winter, once you start freezing, that overrides everything.
Okay.
Right. And people are going to say, I'd rather not freeze in winter and have my home heated, and don't worry about global warming, right? That's kind of secondary.
Yeah, certainly. Thank you. I think that possibly answers Leona's questions about clean energy, but I think I also make another questions about how do you analyze risk premiums to the baseline oil price forecast? Any risk premium models available?
Well, the risk premium is a concept that is typically applied to oil futures prices. And so the oil futures price is not the expectation of the oil price for the future. It's that expectation adjusted for a risk premium that reflects the money you have to pay to convince someone else to take the price risk off your hand. So if you are a producer of oil and you want to guarantee that a year from now, for example, you get a certain price of oil, that's the amount of money you have to pay to someone else to take that risk off your hand. What does that risk premium depend on? Well, it depends intuitively on the composition of people in the market. How many people want to insure that kind of risk? How many people are trying to make money? And what are their perceptions of the future? So that risk premium is very difficult to predict. There's some models to try to quantify it in using data in the past. We know that it's time varying. It can be very large at times. It can be very small at other times. It's in general a difficult object to predict. So most people who forecast oil prices don't worry about the risk premium because they're not interested in predicting the futures curve. They're interested in predicting the price of oil in the future, which doesn't require taking a stand on the risk premium. So I don't know whether that helps in answering that question. If not, let me know.
I haven't got a response from. I think it's good enough. Thank you very much. I think we have time for one more questions. Any questions from the audience? Okay, well, I don't see anybody responding. I think it's pretty late now in your time. Thank you very much once again. It's really a great pleasure for having you here in this first ICSV dialogues, and I hope we could, I mean, the talk, I'm sure that it will benefit a lot of people here, but we do sincerely hope to invite you to come to China in person when it's available, as soon as the quarantine policy drops, and we do really looking forward to that, because I miss international travels. I really all the kind of the conferences, sitting online, it's a completely different story. But anyhow, I think we do appreciate your talk, and thank you very much again. Let's keep contact, and I hope to see you soon. And have a good night, Lutz, and thank you very much once again. Thank you.
Thank you very much. My pleasure.
Thank you. I'll drop you an email later afterwards. Thank you.
Yes, and I'll send you the slides.
All right.
The revised slides.
Okay. Thank you very much. Have a good night.
Bye.
Thank you. Thank you, everybody, for participation. Bye-bye.